Welcome to the deep dive. We're jumping straight into, well, a real cornerstone for investors. Philip Fisher's Common Stocks and Uncommon Profits came out back in 1958.
And it's amazing how relevant it still feels. So today, yeah, we're going to try and unpack it, look at the core logic, see how it holds up now, and, pull out the key ideas you can actually use.
Okay, so let's paint the picture first. 1958, what was happening then?
Right. It's post-World War II America. You've got this big economic boom. Consumerism is really taking off. Technology is bubbling up.
And the start of mutual funds, right? Making investing more accessible.
Exactly. But Fisher saw a problem in all that prosperity, a kind of complacency.
Not just wild speculation, but people getting lazy.
Sort of. Because the market was generally rising, people weren't digging deep enough, weren't really differentiating between, okay companies and truly great ones, relying too much on past numbers.
And missing the future potential. Getting caught up in emotion, thinking short term.
Precisely. He argued against just riding the wave. You needed to understand why you own something. Deeply.
So his answer, his path to uncommon profits.
It was pretty radical for the time. It wasn't about finding stocks that looked cheap on paper today. It was about identifying companies with exceptional growth potential. And he said you could do that through, really intensive research.
The Scuttlebutt method.
That's the one. Shoe leather investigation, talking to people, plus his detailed 15-point analysis.
Find those amazing companies, concentrate your bets, and then sit tight.
Pretty much. Hold them for the very long term. Trusting that great management and strong competitive advantages would just compound wealth extraordinarily over time. It's like becoming a true partner in the business, not just trading its stock.
Okay, so that leads to the big question. Why are we still talking about a book from 1958? What's the core idea that lasts? And maybe what do you have to believe for his whole approach to even work?
Well, part of the lasting power is definitely the Warren Buffett connection. Buffett himself said he was an avid reader, and Fisher heavily influenced his shift towards appreciating quality businesses, not just statistically cheap ones. That's a huge endorsement.
It doesn't get much bigger than that.
And Fisher's whole concept of value was different. Graham and Dodd were focused on price versus current assets, current earnings, tangible stuff.
Right, very here and now.
Fisher looked at price relative to future growth, the potential, the intrinsic quality of the business itself. He wasn't ignoring price. He did say buy when they're out of favor, but the main game was finding quality and trajectory. Uncommon profits came from that long-term value creation.
Interesting. So beneath the surface, what are the bedrock beliefs? What does Fisher assume you accept?
Okay, first, big assumption. You have to believe that these truly outstanding companies actually exist. The ones wired for years of above-average growth.
And not just that they exist, but that you can find them before everyone else piles in.
Exactly. That you can identify them prospectively through deep qualitative work, looking at management, R&D, how good their sales team is, things like that.
Which kind of pushes back against the idea that the market is perfectly efficient, right? That everything's already priced in.
Totally. Fisher's whole philosophy relies on the idea that you can get an edge, an informational and analytical edge, if you do the homework. He thought these great companies had specific traits the market initially overlooks or undervalues, especially those qualitative, forward-looking aspects.
Okay, that's one. What's the other core assumption?
It's all about the people. Assumption 2, management quality and, crucially, integrity are paramount. They're not just soft factors. They are a durable source of competitive advantage.
And flowing from that.
You have to believe that, over the long run, the business's real performance, its fundamentals, will ultimately matter more than the market's short-term mood swings.
He really hammered on management of unquestionable integrity and thinking long-term.
Absolutely. His view is that great leadership builds lasting value. If you picked the right business run by the right people, market fluctuations were mostly just noise, not a reason to sell. It's this profound belief in, human skill and operational excellence as the main drivers. The market votes short-term, but it weighs long-term. It will eventually recognize and reward sustained value creation.
So let's assume you buy into those assumptions. These great companies exist, you can find them, management matters most. How did Fisher actually tell you to do it? What's the operating system?
Okay, pillar 1. The bedrock is the quest for outstanding growth companies. Forget just finding something cheap. The mission is to identify businesses capable of sustained, significantly above-average growth, driven by real advantages and top-notch management.
So not just statistically inexpensive, but hunting for the truly extraordinary growers.
Exactly. He wanted companies with disciplined plans to achieve dramatic profit growth in the long run, and ones with inherent qualities, making it tough for competitors to muscle in. He even said, growth stocks are for every kind of investor, implying the returns from simple bargain hunting just couldn't compare.
And this is where he redefines value price relative to that future growth and quality.
Yep. A clear shift from just looking at current numbers. It's about getting in on that long-term value creation.
I like the analogy I used earlier. It's like not looking for the mature tree on sale, but searching for the sapling with the DNA of a giant redwood, planted in the best soil. You pay a fair price anticipating future majesty, not a discount on mediocrity.
That's a good way to put it. And to actually conduct this search, you need tools. Which brings us to Pillar 2. The rules of engagement, specifically his 15 points and Scuttlebutt.
Let's start with the 15 points. Sounds like a checklist, but you said it's more than that.
Oh, definitely more than just ticking boxes. It's a systematic framework for a really deep dive, covering both qualitative and quantitative aspects. Think of it as a guide for rigorous investigation. We can group them into themes.
Okay, theme 1, business and product excellence.
Right. So, points like, does the company have potential for a large increase in sales? Is management truly determined to keep developing new products, not just rest on their laurels? How effective is their R&D? Does it actually translate to the bottom line? Is their sales organization genuinely better than average? And are there other, maybe industry-specific clues that this company is outstanding?
Makes sense. Theme 2, management and personnel excellence. You flagged this as critical.
Hugely. How are their labor relations? Good relations mean a motivated workforce that's an asset. How about executive relations and management depth? Fisher was wary of one-man shows. Does the leadership have a genuine long-range profit outlook, willing to sacrifice short-term gains? How transparent are they, especially in tough times? Do they clam up? And the big one, is their integrity absolutely unquestionable? That was non-negotiable.
Got it. And the third theme, financial and operational excellence.
This gets into things like, does the company earn worthwhile profit margins? Are they actively working to improve them? Do they have good cost analysis and accounting controls? Crucially, will they need to issue so much new stock in the future to fund growth that it hurts existing shareholders? Fisher preferred companies that could fund growth internally or through debt, avoiding dilution.
Wow, that's comprehensive, clearly designed to force you beyond just surface-level ratios.
Exactly. To really understand the underlying drivers of growth and the holistic quality of the business, it addressed the weakness of just looking at quantitative headlines. It's a structured way to build a detailed story about where the company's been, where it is, and most importantly, where it's likely going, assessing what it's becoming.
So the 15 points provide the structure for your investigation.
And Scuttlebutt is how you gather the unique, real-world intelligence to fill in that structure.
The detective work.
Pretty much. Investigative journalism for investors. Actively going out and talking to people connected to the company, customers, suppliers, competitors, former employees, industry experts, anyone who has a real-world interaction or insight.
Because the best insights, as Fisher said, often don't come from the official reports.
Right. He felt top management's message was often spun, too polished. Scuttlebutt is about getting the on-the-ground realities, the nuances that glossy reports might hide or downplay. It's about seeking out information that isn't widely distributed, trying to gain a genuine information edge, because the official story is rarely the whole story.
Like that investigative reporter hitting the streets, talking to multiple sources to piece together the real picture, not just reprinting the official statement.
Exactly. Okay, so you've done all this work, you've used the 15 points, you've done your Scuttlebutt, you think you found one of these gems. Now the really hard part, maybe. Holding on. Pillar 3, the psychological armor. How do you actually stick with it?
And Fisher's main defense weapon here seems almost extreme, the very long-term horizon. His famous line, if the job has been correctly done, the time to sell it is almost never.
It's radical, but if you truly internalize that thinking in decades, not quarters or years, it provides incredible insulation from market noise. Daily headlines, weekly drops, they just sting less when your time frame is that long.
Coupled with focusing purely on the business, right? Not market forecasts.
Yes. Never sell based on economy or stock market forecasts, he warned, calling them rarely accurate. It's a direct command to avoid market timing.
And crucially, he gives you specific business-based reasons to sell. It's not just never sell, period.
Right. There were 3 legitimate reasons. 1, You realize, honestly, you messed up the initial analysis. The company just wasn't as great as you thought.
Okay, admitting a mistake.
2, the company actually degrades over time. It stops meeting those 15 points. Management quality slips, advantages erode, growth prospects genuinely dim. The fundamental story changes. Makes sense. And 3, you find a significantly more outstanding opportunity, which, if you picked right the first time, should be pretty rare.
So this structured selling discipline acts as a shield against just reacting emotionally to price drops or hype.
Precisely. If the business is still strong according to your framework, a price drop isn't a signal to panic sell in Fisher's world.
So the temperament he's building is one of patience, conviction.
Conviction born from that deep initial research. The intellectual and emotional strength to hold through inevitable downturns.
Independence of thought.
Yeah, not just following the herd, doing your own work, forming your own judgment, being extra careful with stocks that are already market darlings.
And honesty and humility.
Absolutely. Yeah. Having the self-awareness to admit when you got it wrong, learn from it, and move on quickly.
It feels like the armor isn't about not feeling fear or greed, but about having a pre-committed intellectual framework that stops those emotions from dictating your actions. The research builds the conviction, and the conviction is your shield.
Well put. The strength comes from the process. If you truly understand why you own something, based on deep work, you're far less likely to be shaken out by market noise or lured away by the next shiny object.
Like that ship captain analogy again. You charted the course based on deep analysis of the star at the company. You expect storms volatility. You don't abandon ship in rough seas. You only change course if the star itself dims the fundamentals decline or a much brighter, demonstrably better star appears.
Exactly. Okay, so that's the theory, but it was developed in the 50s. Let's stress test it. How does this hold up today? AI, biotech, globalization, information overload. Where does it work and where might it bend or even break?
Good question. Let's start with where it seems timeless. Can we apply this thinking to, say, a modern tech giant like NVIDIA? Obviously, Fisher never analyzed it, but could his framework apply?
We can try the thought experiment. Point 1. Market potential for big sales increases.
Yeah.
GPUs driving AI, data centers, gaming.
Yeah,
that seems to fit.
Point 3. R&D effectiveness. Massive R&D spend, continuous innovation like CUDA seems central to their success.
Point 9. Management depth. You'd have to really dig into the whole team, not just the CEO, but it's a relevant question. Point 15. Unquestionable integrity. Always relevant, arguably more so today.
And scuttlebutt for NVIDIA.
You'd be talking ethically, legally, to AI developers, gamers, cloud providers, maybe even trying to understand competitor perspectives beyond the official lines, trying to grasp the reality behind the PR.
So it feels like the core principles focusing on management, innovation, competitive advantages are maybe even more important today in this faster-paced, knowledge-driven economy.
I think you could argue that. Yeah. Fisher was really ahead of his time emphasizing these softer qualitative factors. And the long-term buy and hold, well, it's debated more fiercely today with HFT and quarterly pressures.
But the results speak for themselves sometimes.
Right. Allowing great companies to compound over decades is still a massively powerful wealth creator. Fisher's framework is aimed at identifying the kinds of companies where that strategy makes sense. The deep research, the focus on durable advantages or moats, management quality, that stuff feels timeless. The specific application might change assessing R&D for software versus a 1950s chemical plant. But the goal is the same. Understand what drives long-term durable growth.
Okay, but let's push back. Where does the model start to creak? What are the valid criticisms or limitations today?
Well, certain market environments are tougher for it. Highly disruptive industries where tech cycles are super fast, long-term might be 5 years, not 30. Holding almost never gets really tested when a company's core tech can become obsolete much quicker than in Fisher's industrial world.
And what about big macro events? Things beyond just market sentiment?
Yeah, prolonged periods dominated by huge external forces, massive monetary policy shifts, pandemics, major geopolitical crises, deep recessions. Even the best companies get hammered. That tests your resolve to hold indefinitely in a way that simple market volatility might not. Fisher talked about buying when out of favor due to market conditions, but a true systemic shock is different.
Are there types of businesses it just doesn't fit?
Oh, definitely.
Yeah.
It's not designed for, say, highly cyclical commodity producers, companies with no pricing power, undifferentiated products, whose fate relies entirely on the commodity cycle. They don't fit the sustained growth model.
Or turnarounds.
Not really.
Yeah.
Fisher sought strong companies that were maybe temporarily unpopular, not broken businesses needing a complete overhaul. The 15 points kind of assume a baseline level of quality and competence already exists.
Let's talk Scuttlebutt again. That feels like a major area impacted by today's world.
It is. Regulation Fair Disclosure, or Reg FD, from 2000 is huge. It basically prohibits companies from giving out material non-public info selectively. So, the kind of potentially privileged tidbit Fisher might have picked up from a supplier chat could be illegal to receive or act on today if it's not public knowledge.
So that edge is harder, maybe impossible to get legally.
That specific kind of private informational edge, yes. And then there's just the sheer amount of public information now. The internet, social media, Glassdoor reviews, data analytics, sophisticated funds use AI to scrape and analyze everything in real time.
So can an individual really gain a unique information edge anymore?
It's much harder. The edge probably shifts from finding secret data to doing superior analysis, synthesis, and interpretation of the vast amounts of public data. Maybe focusing on less covered companies, asking better questions, connecting dots others miss, actively seeking disconfirming evidence. The Scuttlebutt spirit might be more about deeper analysis of public info and diverse sources now.
What about the risks inherent in growth investing itself?
Big ones. Growth stocks often carry high valuations, reflecting high expectations. If growth disappoints even slightly, or sentiment shifts, those stocks can get crushed the growth trap. You risk overpaying.
And volatility is just part of the deal.
Absolutely. Test that psychological armor constantly.
And that concept of reversion to the mean, the idea that super high growth naturally slows down over time.
That's a fundamental challenge. Studies show extreme growth rates and margins tend to moderate towards average. Investors often mistakenly extrapolate temporary high growth way out into the future. Fisher's searching for the exceptions, the rare companies that defy this gravitational pull through durable advantages. But the risk is misidentifying a temporary winner as a permanent one.
Any other limits we should mention?
Well, the concentration risk is real. He advocated maybe 10, 12 stocks. Great if you're right, disastrous if a few go badly wrong. Also, attempts to turn his qualitative approach into quantitative screens have had, let's say, mixed results. Suggests the magic might be in the human judgment that's hard to code.
And that point about management talks freely seems tougher today.
Yeah, with polished IR departments and media training, discerning genuine transparency from slick PR is a real challenge.
And his view on dividends being irrelevant.
Probably too sweeping. It ignores mature, profitable companies that can grow and pay dividends. And it understates how much reinvested dividends contribute to total return over the long haul.
Okay, so we've got the pillars, the tools, the armor, the modern stress test. How does this all come together? If you had to boil common stocks and uncommon profits down to one core transformative mental tool for listeners, what would it be?
When you weave it all together, the quest for growth, the investigative methods, the psychological discipline, it's a really coherent system. It's about deep understanding, focusing on the future, and having the patience to let compounding work. It marries rigorous analysis with emotional fortitude. It changes you from just picking stocks to being a long-term partner in value creation.
And that single most powerful tool to steal?
I'd say it's the investigative investor mindset.
Okay, unpack that. What does that mindset really mean?
It means committing to go way beyond the surface level, beyond headlines, press releases, analyst consensus. It's developing a deep, genuine curiosity about how a business actually works. The nuts and bolts, the competitive dynamics on the ground, the real quality of the people, the authentic long-term prospects. It means embracing the spirit of Scuttlebutt actively, relentlessly seeking diverse qualitative insights even from public sources to build a rich, multidimensional picture that isn't just the company line. And using a rigorous framework like an updated 15 points to structure that digging and make sense of it all.
And why is that mindset the most powerful thing Fisher offers, even today?
Well, first, it leads to deeper understanding and real conviction. When you truly grasp the business as a living thing, you build the kind of conviction needed to hold steady during market panics. Second, it forces you to focus on the future drivers, not just past results. Financials look backward. This mindset pushes you to assess what will create value going forward. That's where the uncommon profits are.
And you mentioned a potential qualitative edge.
Right. In a world awash in quantitative data crunched by algorithms, deep qualitative insight, understanding culture, management effectiveness, customer loyalty that's harder for machines, it can still offer a human edge. And finally, grounding your decisions in this kind of deep, independent work makes you far less likely to chase fads or get swept up in FOMO. Your conviction is earned, not borrowed.
So the investigative investor mindset boils down to relentlessly asking why.
Exactly. Why are they successful? Why will they keep being successful? Why trust this team? Why are customers loyal? That deep probing questioning, guided by the scuttlebutt spirit and structured by a framework, is what separates superficial analysis from potentially game-changing insight. It's the engine of Fisher's whole approach, and it's incredibly valuable today.
So Philip Fisher's book, it's definitely not an easy path. It demands real work, honesty, critical thinking, really getting your hands dirty, understanding businesses.
For sure. But the potential rewards, both intellectual and maybe financial, are, as the title says, uncommon. That investigative investor mindset is a powerful addition to anyone's toolkit.
Okay, let's leave everyone with a final thought then. In today's world, absolutely saturated with instant data, with algorithms analyzing everything, how can you, as an individual investor, still find ways to uncover genuine, forward-looking insights the market hasn't fully grasped yet? Relying not just on numbers, but on that deep human understanding of a business and the people steering its future.